Hello, I'm Kelly O'Byrne and welcome to LCG's preview for the year ahead. The first few days of the year can be typically rather quiet, so I'll be talking to our Head of Research, Jasper Lawler, to get his market outlook for 2018. So, hi Jasper.
Hi Kelly.
So let's run through some price trends in markets that are most popular among our clients.
Yep, absolutely. Yep, good one. I think, a quick one just on forecasting in general and trading is that I once heard the sentence, strong opinions loosely held. So that's the way I take things, is that we've got some trends in place and there's reasons behind them, but you've got to take the fact for what it is. If we see some strong reversals, you've got to start reassessing whether actually those same fundamental factors are still in play, whether it's a pullback or whether it's a reversal.
Yes, okay. Right, and so let's get to it then and look at the factors that are at play next year. Let's start with Forex. So give me your take on euro dollar firstly.
So we're generally still bullish on the euro. We have been since February or so, 2017. I think the same factors are at play, which is basically improving European economic growth and mainly just the fact that the ECB is exiting QE, which means the policy difference between the ECB and the Fed is just getting closer. So even though the Fed's raising rates, the ECB are going to be tapering their asset purchases.
Okay.
The risk to that outlook and why we could get a pullback is there is some political uncertainty. We've got the Italian elections, for example, and just that the ECB are just very dovish in their forward guidance. That would be another reason why actually the euro can pull back. Looking at the monthly chart, you can see there's a monthly engulfing candlestick pattern. That follows a successful retest of the 116 level as resistance turned into support, and the RSI is above the 50 midpoint. So that's all positive for the euro for the time being. Okay,
great. And cable then?
Yeah, same thing. We're for the meantime we're positive on cable, just mainly because not Brexit related, mainly because the Bank of England are no longer easing policy and they're starting to raise rates, albeit very gradually. Risk to why we could get a bit of a snapback in sterling and maybe 140 acts as a resistance is that we get a no-deal Brexit, or looks like we're getting close to a no-deal Brexit, or just the Bank of England talk about a kind of one-and-done scenario on the rate hikes, and so then that obviously reduces rate hike expectations. So risk of a bit of a kind of rise and a bigger pullback, I think, maybe with sterling. Looking at the monthly chart, a move beyond and retest of the 20-month moving average is good. The down slope of the 20-month moving average and the monthly RSI still below 50. Again, are some technical reasons why the upside could be limited near around 140.
Okay, and let's look at one more currency pair, dollar yen.
Yep, dollar yen. Well, inflation's very low in Japan. It's also low in the US, but it's still higher than Japan. I think the re-election of Shinzo Abe, that probably reinforces Abenomics, part of which is basically devaluing the yen. So I think probably they continue that policy for a while. So that, in effect, strengthens dollar yen, dollar going up, yen going down, obviously. A risk to that is that the other central banks are starting to tighten now. So there's only so long the BOJ can go against the tide. And so one of the things they're doing at the moment is targeting the 10-year yield in Japan. If rates start going higher across the board, they're just not going to be able to do that anymore. And so those higher rates in Japan would actually attract people back into the yen. So that'd be a risk for why the yen goes up.
Yeah, okay, thanks.
Looking at the chart, signs of strong demand near the 108 level would imply an eventual continuation, I think, of this strong upwards impulse that we saw in November 2016.
Sorry to rush you there,
That's
Jasper.
all right.
So moving on to indices, what about Wall Street then?
Yeah, obviously global stock markets are in a raging bull market. Doesn't seem to be any evidence that that's ending at the moment. So we can stop and reassess once we get a pullback. If it's a very dramatic pullback, I'd be more inclined to think that actually it tops in on any subsequent rally. But at the moment, it looks good. In terms of the US, we've obviously got Republican, pretty market-friendly policies. I would say that the tax reform is pretty much priced in at this point, but we do perhaps have deregulation on the go. Seems probably unlikely that we're having any massive infrastructure spend, but deregulation could be good for certain areas of the market, like we saw a bit of a rotation into banks at the end of the year, so they could become market leaders if that deregulation agenda gets through. The biggest risk is that basically, the bigger picture is that markets are rising so much because of the easy monetary policy from the Fed, and they're cranking that back next year. So, eventually we're going to see the kind of follow through on that. We suspect that probably 2018 is like the transition year, where maybe things go a bit sideways, and then 2019 has the bigger risk of the bear market. In terms of the chart, the monthly conditions are even more overbought on the monthly one than the weekly chart. So the gains, they're almost exponential when you look at this chart. A monthly close below the low of the previous month would be one warning sign that we're looking for that these overbought conditions are reversing.
Okay, interesting. Okay, so moving more closer to home for us, let's look at FTSE 100 now.
Yeah, I mean, it's underperformed other benchmarks this year, which is understandable. I think basically, even if it's not particularly justified in terms of its economic impact at the moment, international investors are just scared of investing in Brexit Britain. And so it's not getting the same kind of fund flows it once would. I think basically for next year, we're positive. We think probably we do get a breakout, maybe even hit 8,000. But it's going to rest on the sort of battle between sterling staying undervalued and Brexit as a risk, and just the context of a global bull market.
Okay.
So looking at the chart, the longer term outlook for the FTSE, as I said, still looks positive. We've got this rising 20-month moving average and the price making higher highs and higher lows.
Okay. And let's touch on European indices then as well.
Yeah, again, the European growth is a positive factor there. And so I think that positive economic growth will feed through to earnings growth. Markets obviously price in ahead of time the future discounting mechanisms. So we saw a good rally in European equities this year, even though there wasn't the earnings growth, but that was kind of pricing in 2018, arguably. So there's a risk that you get a bit of a kind of selling the fact, if you like. But I think probably overall the trend is still higher. The bigger risk factors, maybe it's those old age worries about the undercapitalized banks, and maybe even just China deleveraging, since particularly Germany, if you look at the DAX, they've got a strong export market into Germany, so that's a risk factor.
Okay.
So the trend on the DAX monthly chart is higher, but it's been over a year since the price fell below the 20-month moving average, so that does increase the chances of a near-term bit of mean reversion to a pullback, essentially.
Okay. Very good. Right, so let's go on finally to commodities. What about oil?
Yeah, so I mean it's trending higher in the medium term at the moment. Basically, that's supply glut reversing. The OPEC cuts in combination with the reduced capex from the big oil companies means that supply is coming out of the market. The risk is just what we've been saying from day one, is that every time the price moves higher because of this reduced supply from OPEC, that actually the US make up the deficit with shale oil. That extra production floods the market again and sends the price lower. So that's why we think it's looking positive at the moment, but maybe the gains are capped in around the kind of $70 mark, probably. So looking on the chart, you can see on a monthly basis, Brent crude appears to have bottomed. Seems like it's broken out of that inverted head and shoulders pattern, but maybe it doesn't make the full objective of the pattern. It stumbles around 70 or so for another pullback.
Okay, great. And moving on to gold then, finally.
Yeah, so gold's, I mean, it's basically trading sideways. It's in a range. And so I think that makes sense fundamentally, because we've got this loose environment which is pushing stock markets higher. It should be good. It should be pushing up inflation, and gold's an inflation hedge, but actually inflation is remaining low. And just the fact that stock markets are pushing higher means you don't need that haven for gold. So it's kind of, I think more, it's just been the weakness in the dollar that's helped gold this year. The underlying demand's not quite there. So looking at this chart, you can see that there's still resistance from that 1370 to 1400 per ounce mark. So that keeps gold in its range. If we get a breakout from there, that changes the whole environment. But I think we're still neutral for now. A monthly close below the 20-month moving average and below the 50 level on the RSI could actually see a retest of those December 2016 lows around 1150.
Okay. Thanks, Jasper. And thank you very much for watching. We'll be back with the usual week ahead video next week. But remember, if you want to see these videos as soon as they're released, please follow LCG on social media. Happy New Year.